It's time for Wise Money with Korhorn Financial Group with financial advisors Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of Wise Money with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. I am your host, as well as one of the certified financial planners on the show. My name is Mike Bernard. Across from me, certified financial planner and my friend, Josh Gregory.
Good morning, Mike.
Hi.
Hey, if I would have asked you at the beginning of 2017, how do you think the stock market was going to do? I can about guarantee you would have significantly underguessed,
Yes.
right?
Yes.
It was an amazing year, and we want to talk through what went so well and what's in store for the year for us over the year ahead here. What do you need to do with your investments? That's all coming up on this hour of the Wise Money Show.
I know, it's dessert. It's dessert. Talking about investments, it's one area of your financial life. It gets most of the attention when you're thinking about your finances. We're talking about it all day today. If you have questions, and I know you will, reach out to us. You can do so in a few different ways. Online, wisemoneyradio.com, you can reach out and send a question right there on the right, as well as catch up on previous episodes. You can give us a call or shoot us a text, 574-222-2000. Lastly, all over social media, Facebook, Twitter, and YouTube at Wise Money Radio. Every episode is on the YouTube channel. Check it out. That is how I enjoy following the show and just seeing how we're doing and all of that. So, what is the market going to do this year? Like
Great
always, it's really anyone's guess. But like Josh said, if 1 year ago, 12 months ago, if you made a guess, and our own Kevin Korhorn made a guess as to what the market was going to do in 2017, most likely you were way off. Kevin was not.
Really?
Actually. Yeah.
I don't remember his guess.
We are not really into predictions here. I know a lot of economists and financial advisors are. In my opinion, that's just a way to gain attention for themselves because it's anyone's guess. Kevin turned out to be pretty close. But before we talk about why and then what to expect in 2018, let's talk about what actually happened. What were the results in 2017?
Yeah, you know, if we were to recap what happened in all corners of the investment universe, I like to think of these as almost the box scores after, a weekend full of sports or a week full of sports, that sort of thing. But if I was going to use this analogy, I would want you actually thinking of all of these different performance numbers as different stats for players all on the same team.
Yes.
Too often we think of, my stock investments did really well, but the real estate over here didn't do as well. And we almost think of, I wish I hadn't had so much money over here. I prefer that people think of their portfolio as really a compilation of different players all on the team with different skill sets that are going to be really kind of pulled to the forefront at different times.
Yeah.
You know, you're going to have years where your stock investments are stinking up the house, and your only redeeming grace is the fact that you have some of those boring bond investments in there, right?
Yep.
So think that way as your portfolio is really a compilation of all these great investments. So we look at a lot of different indices, different measuring sticks on how these various types of investments have done. The S&P 500 is one of the first places that we start. Mm-hmm. What an amazing year, up almost 22% last year.
Yep.
Way, double what its long-term average would be.
Yeah.
Pretty amazing. Now, the S&P 500, if you're not familiar with that term, that's measuring the 500 largest U.S.-based companies.
Yep.
Okay, so big names that you and I have heard of that you're familiar with, the Amazons and the Googles and so on.
A lot of people focus on the Dow. Dow is just the largest 30, and the S&P 500 is the largest 500. So it's really a better measure of large U.S. stocks. Believe it or not, even though that gets a lot of attention, historically, small cap stocks actually take a little bit more risk but have a little bit better return over the long term. Not so last year. Small cap stocks still did unbelievable, but we're up just over 14%. Here's the surprise, though, was what happened in international markets.
Absolutely. International investments, stocks in particular.
Yep.
Up over 25%, almost 26% for large, well-developed countries, the companies that operate in those, almost 26%. Smaller, more up-and-coming economies around the globe, the corporations that operate there, which we would refer to as emerging markets, the Chinas, the Indias, the Brazils of the world, 37.8%.
Yeah, and let me just take a quick tangent here. I've had many people come into my office, and maybe this is you, maybe you've thought this, we've talked about it on the show, have come into my office over the past several years and have wondered, why do we still have these international investments? Because out of the previous 4 years, international investments have performed worse than U.S. investments. And many of them have just been very, very frustrated, especially with emerging markets, because 2014, 2015, and 2016, emerging markets were negative. They had a negative return during those 3 years. And yet we believe in long-term diversification, and I hope you do as well. And it really paid off last year, finally.
Yeah, absolutely. Now, keep in mind, as you're hearing some of these statistics, you don't want to rush right out and say, oh, now is a great time to go load up on those emerging markets. Obviously, they've got the hot hand, right?
Yeah.
To go invest in something that's up 38% may be a fool's game. But also, just keep in mind that most people, when they're building out a really well-diversified portfolio, we often use the analogy that you're following a certain recipe, getting the right balance of all the right ingredients in there so that things bake up correctly. Most recipes that I see out there call for maybe 3 to 5% in this area.
Right.
So if you're wondering, why is my portfolio not up 38%? Well, most likely, if you have exposure to those emerging market stocks that we were just highlighting, it's a very small sliver of the overall portfolio.
That's right. That's right. A couple other areas to hit real quick to round out the diversified portfolio. Real estate investments, which actually have been pretty hot over the past few years, still posted a great return, but less than those equity markets, 8.7%. Commodities, which have continued to be sluggish over the past few years, did pretty well in 2016, only up 1.7% in 2017. A lot of economists, we'll talk about this in just a moment, are predicting commodities to rebound in 2018. And then finally, bonds, your safe, steady, predictable bonds, which this is huge, folks. We're going to come back to this, posted a positive 3.5% return. So when you look across the board, those broad areas that you can invest in, not a single negative number. That's not normal. So 2017 really was an anomaly. If you stayed invested, if you were invested and stayed invested, you were rewarded. Let's talk about why. What were some of the driving themes for 2017? And then we'll carry that forward into, well, what do we expect and how should you position your investments for 2018?
Well, okay, so throughout the year, as we were talking about this with clients, what is driving all this success in the markets? Haven't your conversations just started with politics?
Yeah.
That's where most people's minds go to. A lot of people wonder, well, how much of this is a Trump effect, that kind of thing. And, I've personally never believed that the president should get all or none of the credit for how the economy and the stock market is going, right? So to politicize this, but here's the reality. A lot of the agenda items, political that have been brought to the forefront now with this new administration have been well interpreted or well received by Wall Street.
Yeah.
Okay. So take your own personal politics aside, whether you love the guy or are scared to death of the guy or anywhere in between. Regardless of where you are on that, Wall Street likes what it's been seeing.
Mm-hmm.
And much of that throughout the year, in my opinion, was driven by the proposal for tax law changes.
Yep.
It was billed as tax reform. It kind of got diluted down to maybe tax cuts for most Americans. I think it really still was true tax reform for corporations.
Yep.
It was a significant move there, and that's why Wall Street was liking what they were hearing throughout the year. They were hopeful that things were going to go through simply because it puts profit straight down to the bottom line, and that drives stock prices.
My guess is we're going to be talking about that a little bit more as we talk about themes for 2018. Let me ask you a question, though. What about the Bitcoin and cryptocurrency theme? We've got our take on that coming up, as well as how you should position your investments for 2018. That and more coming up here on Wise Money with Korhorn Financial Group.
I don't even look at the clock when I sit here. I'm just like dialed into what you're doing.
I think you saw.
Yeah. You're like, hey, over there.
You read what I was communicating through the ether. So there's a few more themes we need to hit, and
Oh yeah, we barely got going there.
and we can pick back up the tax plan as we talk about themes for 2018. So because I have a few comments there as well. But. All right, I have 2 or 3 other themes. I don't know how much time we want to spend on that. Do you have others that you say we?
I had like 3 more, but
Okay.
I could maybe hit 2 of them, or maybe you have them already.
Low volatility, interest rates, and just economic strength.
I had interest rates and corporate investment.
Okay, that'd be good to hit.
So I'll scratch that one. So maybe, basically between the 2 of us, there were 3 there, it sounded like?
Mm-hmm.
Okay.
Sounds good. Have you invested in Bitcoin or cryptocurrency? Should you? Both of those, great questions. We've got our take here coming up. This is Wise Money with Korhorn Financial Group. Thanks for being with us. My name's Mike Bernard, along with Josh Gregory. Just the 2 of us today. Kevin Korhorn usually with us. He is out on vacation. Special thanks to the attorneys at Ledoux, Curran, and Keene, as well as First State Bank for making the Wise Money show possible. As always, we'd love to hear from you. This is your show. Today is dessert. We're talking about investments, what happened in 17, what the forecast is for 2018. If you have questions or comments, concerns, reach out to us. 574-222-2000. You can call or text. wisemoneyradio.com. Lastly, social media, the YouTube channel, all of that at Wise Money Radio. So we hit the high level of what happened to the market in 2017. All broad asset categories were positive. That rarely happens, but that's fantastic news. We're going to talk about what our thoughts are on 2018, but we're running through why did the market do what it did last year? Part of it was the tax plan. I'll tell you the other one, and this is, I don't know if it drove the returns or it was just a component of them, but wildly low volatility, wildly low. One of my favorite charts, and if Kevin was here, I know it's one of his favorite charts as well, is we've got this really geeky chart that looks at intra-year declines in the stock market. So what do I mean by that? So normally we focus on where the market finished the year, or so how did the market do for the year? Well, what about within the year? What was the greatest peak to trough decline? Because, the market's a roller coaster, up and down. And of course, between January 1 and December 31, there's a lot of other ups and downs. And so this chart measures that. On average, it's about a 9% decline that you see throughout the year. That's a big deal. That feels kind of scary to investors. Last year, the biggest intra-year decline from last year was only 3%. That ties the lowest level in, I believe, over 30 years.
That's amazing.
It is amazing. And so we've shared before, just want to remind you that's not normal. That's not how markets work. But it was surprisingly just a calm ride with all of the big political concerns and conflict concerns throughout the world. It was just a surprisingly smooth ride. And I would just tell you not to expect that moving forward. But that was a big theme for last year, in my opinion.
That's right. There were a lot of different wins in our sales last year. One of them being politics, which we talked about in the last segment. Another one is just the simple fact that interest rates are still low.
Yeah.
At this late stage in the game, we've been running strong in the stock market for a lot of years, and the Fed has not had significant run-up in interest rates. It's a very slow increase that they've been having, especially compared to how they've approached interest rates in the past. Mm-hmm. And that's a theme, I think, that maybe we didn't give a lot of attention to throughout the year, but it was certainly something that supported the stock market moving higher. this slow, gradual increase that's been happening.
And let me just point out that positive year that bonds posted as well, that was surprising in light of how interest rates move. They did move up. The Fed did move interest rates up, but very slowly, very methodically, really right on plan. And that didn't spook anyone. You guys know that when interest rates go up, bond values go down. So usually the bond investments, bond indexes go down when interest rates are going up. Yeah, you're right. It did not get enough attention last year. And when we look back on 2017, that's a big theme.
You know, another theme that stood out to me is the fact that here we are as a nation at what I would consider full employment.
Yep.
Most people, and maybe we have a listener or two who are not working yet or between jobs or something, but this is about as low as the unemployment rate can really go in an economy as diverse as ours. And in fact, many business owners that we work with, their number one struggle is finding people right now.
Yeah.
They could hire more people, they want to grow, but they just don't have the people to do it. And so what is the response when you can't find a human to go do the job? You have to equip the people working for you better. Better technology, investment in infrastructure, somehow find a way to streamline your processes so you can get more productivity out of the current employees that you have. And all that investment into, robotics or artificial intelligence, new systems, that sort of thing, all of that is an investment into the economy, but it's also a driver of the stock market as well.
Yeah, that's right. That's right. That was a big driver. Technology, if you look at the individual sectors, that really stood out. The last one that we're going to hit, and I teased it out earlier, is, gosh, you would have been, it just would have been one of the headlines if you thought about investments for 2017. The first thing that came to mind, Josh said politics, you might say Bitcoin in cryptocurrency. So I've got my take on this. We're not going to spend too much time on it. I know you listening, you have a take as well. You might have invested yourself. You maybe are tempted to. Our own team member here, and he helps out on the Wise Money Show, Daniel. He had some Bitcoin long ago as well. So, Josh, what's your take before I share a little bit of mine?
Well, no offense, Daniel, but I think, have people lost their minds? That's what comes to my mind. Holy smokes.
You're going to hurt some feelings.
I know I am, and that's kind of why I said it in the extreme here. But, I personally don't think of Bitcoin as a true investment in the sense of the term that I've been trained on, right? Okay. I think of, I remember back to a book I read by Benjamin Graham, who was Warren Buffett's mentor and one of his professors, a guy who wrote the book on how to analyze an investment, how to pick investment opportunities, that sort of thing. And he draws a very clear distinction between speculation and investments.
Yeah.
In his opinion, a true investment is something that you can analyze and you can have a predictable rate of return, a relatively safe return if you've kind of crunched the numbers correctly. There shouldn't be a big surprise that happens with a good investment.
Yeah.
Okay. I think of my client who owns a bunch of farmland. He decided he was going to put an irrigation system in. That, to me, was an investment. We could calculate exactly what he was going to receive in greater rents because of this. We knew exactly when the payoff on that thing was going to be and what his rate of return would be. That's an investment. He's not just dumping money into some equipment and hoping for the best, hoping that it spikes in value or something. That's really what's happening with Bitcoin. Mm-hmm. It's not something that's going to generate income to you in your life. Its real value to you ultimately is, if I buy it today, can I find someone else to sell it to at a bigger price down the road? That's how you're going to make your money. And unfortunately, right now, on such a small market, mm-hmm. a developing market, if you will, it can be extremely volatile, as we've seen. I mean, a significant double-digit return drop in one day, that doesn't scream investment to me. That screams speculation.
It's definitely speculation. It is appealing, and it's very tempting. And I'll tell you, if you're interested, we would say Investing is not gambling. It's very different for the reasons that Josh mentioned. Long-term, predictable return, very predictable patterns. We don't like it. It goes up and down. You have no idea where it's going to go each day, each month, each year. But over the long term, pretty reliable. Gambling, you have no idea. And oftentimes it's a zero-sum game. If you have play money and you wanted to jump on this ride, just know the risk, okay? I've been telling folks it's worth nothing. We just don't know yet. We have no true, real, confident, clear picture of what the technology world is going to look like in 5 years, in 10 years. And if the blockchain really takes hold and win, and if cryptocurrency actually reigns during that time, will Bitcoin be the one? If all of that happens, then it might have some value, like the dollar does today. But right now, without that in place, we just don't know. So truly, it's speculating. And the wild swings from day to day are just pretty dramatic. So not for my taste. And I don't know about you, but if you're tempted, just play money. Just play money, folks, not with the core of your portfolio. Let's talk about the core of your portfolio. What's ahead for 2018? What are the big fears? What are the big opportunities? How should you position your investment? Should you tilt one way? Should you overweight to another? What strategies should you use? We've got all of those thoughts and ideas coming up here and more on Wise Money with Korhorn Financial Group.
Wink, wink.
Hey, I got $20.
I know.
And it turned into $200. So.
Yeah, so who looks like the idiot? Me, right?
Yeah.
For
And if I would have hung on to it, I could have. I would have jumped out at 15, and it went to 20, and now it's back to 15.
yeah.
So.
And people have similar stories with gold or silver and things, or some hot penny stock that they were gonna just take a flyer on. I spent $500 on this, and now it's worth 50,000. I mean, those stories exist, and that's why they capture people's attention.
Of course.
Right?
Yeah, of course.
And you might begin to believe, oh, well, that's my ticket to financial freedom.
Right.
Is I just need to hit it big.
Those are lightning moments. Those are
Right.
not.
Right. It's not a repeatable process, is the point.
Okay, Joshy. So third segment here. Let's hit our themes. That could take the entire segment. Do we make sure we have time for questions in the fourth segment? I'm thinking so.
I think so, yeah.
So I think we hit our themes. We ignore kind of that second comment there in the second segment, and then we touch on I actually have a potentially great story for talking about our philosophies. So I think we hit themes and then just touch on our philosophies.
Oh.
So that would catch us up. Or is that too aggressive?
No, I don't know if I would add it. I personally will add anything to the investment philosophies, but
Okay, we'll see.
yeah, if you want to hit that.
We'll see. All right.
I feel like, hang on a second, because I want to identify, and maybe we can look at it at the next break. There were some good questions in here that I thought, wow, we have got to get to that one.
Yeah, my hope is, segment 4 has how many questions? 2 of them? 3 of
There
them?
were like 3 or 4, I thought.
I think there's 3. And
3?
so, yeah, hopefully we can get all the investment stuff done in this segment, and we've got that for the 4th.
Yep.
Thank you for being with us today. This is Wise Money with Korhorn Financial Group. My name's Mike. I've got Josh Gregory with me in the KFG studios. Thank you to Bethel College Adult and Graduate Studies, as well as Diane Bennett with REMAX 100 for partnering with us on the Wise Money Show. If you have any questions, let me just remind you, call, text 574-222-2000, wisemoneyradio.com, as well as Facebook and YouTube and Twitter at Wise Money Radio. Today is our 2017 market recap, 2018 outlook. The 2018 outlook is on the horizon. Josh, I told everyone we're not really into predictions. Do you have a prediction on 2018? What the market's going to look like?
No, I really don't. And that's important, actually. You know, I know that's not a cop out or anything. The idea of having predictions. We are not fortune tellers. We are not sitting here with our crystal ball and have some sort of sense where the market's going to, take a quick turn this direction or that. However, we do pay attention to what is driving the markets right now. And that's partially because our role as financial advisors is to be kind of the tour guide as we're going through this process. Mike, I've been talking about it for the past couple of weeks nonstop. It's Disney week, right?
Yes.
I'm ending Disney week here, really. First trip to Disney. It was part of the big Christmas present for the family. I've never been to Disney. My kids have never been to Disney. I felt like I had to do a bunch of research on some of these rides that we were going to be encountering.
Yeah.
Mostly so that I could be kind of coaching our kids, because some of them were a little apprehensive about some of the roller coasters and things. And I remember watching a video on Expedition Everest.
Oh, yes.
Right?
Seen that video.
Yep.
And
I felt like I needed to know, well, where's this big Yeti monster going to be hiding so I can warn my kids and know the tracks don't really break and we're not going to go sailing off the tracks here. Yes, we're going to go backwards. Just kind of coaching them along so that as we're on the ride, they're not freaking out.
I know
right?
some of you listening right now are thinking, you're ruining it. Josh, you're doing
know.
parenting all wrong.
I know. Watching a YouTube video before you go to Disney ruins it for me.
Yeah.
I want the excitement of the unknown, but I'm a parent, right?
So for those of you on YouTube, last time we went to Disney, Cindy and Carrington rode the Expedition Everest ride, and it snaps a picture on the way down, the big drop. And the picture that it got was Cindy smiling and laughing, and Carrington just eyes bugging out of her head and mouth wide open. It is so precious. It's the best.
That's awesome. Well, in many ways, that's our role as financial advisors, right? And I think the moral of the story here, though, is that investing can be fun if you can somehow take the fear out of it. That, this drop that we're going through or this economic condition that has developed here, it's not going to ruin you. It's not going to have you broke by this time next year. Mm-hmm. Our role is to help kind of interpret what is happening as we're going through it so that panic doesn't set in.
Well, let's start with that then. If we're going to rattle off a couple of themes that really could drive the market in 2018, let's start with fear and the potential conflict across the pond there in North Korea. That has a lot of people spooked, and I have to tell you, this is why we're not in predictions, because who can predict exactly how that's going to play out? No one. We have no idea. If a conflict happens at the scale, the magnitude that we're dealing with these days, it could spark a lot of fear. Markets don't like fear; they don't like uncertainty. Surprisingly, markets typically do well during war times. Government's spending a lot of money, and so what would I tell you to be prepared for on that ride if it happens? Yep, there's going to be some short-term panic and fear in the markets, but I would hope if history is any indication of how things would perform after a quick drop with some panic and fear, market hopefully would recover. We just don't know, though. We just don't know. And if you're positioning your portfolio for a potential conflict there, then you're speculating. That's gambling because we just have no idea.
That's right. You want to be prepared to the best you can for the unexpected, but don't base your financial plans on a scorched earth scenario.
Yeah.
Right.
The other one is that, the markets are too high right now. So that'll be a theme in 2018. I'm not so sure. I think it's really just going to come down to is the economy continuing to expand, GDP continuing to rise at a rapid clip. That's expected, and corporate profits coming through at record highs. I don't think that's out of the question. That's what the market's expecting. I think with the tax plan, that really could be a reality. Betting against that, you might be right. I don't know. We just don't know. But
that's what the Fed is going to be watching.
Yeah.
And I actually consider that to be another of the key themes that we'll be watching this year, because there's going to be a changing of the guard happening. It's right here upon us.
Yeah.
And, Jerome Powell, that everybody's kind of watching and trying to get inside of his head in particular, What's his take on interest rates going to be? How aggressive will they be with increasing rates? Are they going to be tapping the brakes pretty heavy or letting things continue to develop in the economy? That's a big question mark. Anytime that you have a new Fed chairman coming in, there could be a change in philosophy. New captain steering the ship may take it in a different direction.
That's right. Yeah, that will be another big theme as well then as what actually happens with interest rates. We told you earlier that interest rates did a slow and steady rise last year. That's what the Fed's plan was. Apparently, the new Fed chair is everyone says he's in the same that same line of thinking. But will bonds continue to do okay in a rising interest rate environment? And will the market be able to anticipate and plan for those interest rate rises, or will they be caught off guard? So those are the driving themes. But here's the deal, and some of those could turn out the opposite of way the market's thinking, or could be a surprise, and that could make things jittery. I was meeting with an individual just a few weeks ago, and this year he's retiring. It's exciting. It's fabulous, and he's done a great job saving up. And so as we start talking about, well, are you ready and how are things positioned? He put the $1 million or so that he has, he put it in cash because he knew he was retiring this year, and he knew the market was high, and he's pretty convinced there's going to be a drop, so he put it in cash. And so I don't know what philosophy you are or what investment strategy you're employing, but I would remind you, as I reminded this individual, that you're investing really for the next several decades. So he was in his early 60s. He's investing for 30 years. And yes, he's retiring. And so it may be prudent to have some dollars, a decent portion of what he's going to need to live on over these next few years, and very slow, predictable, steady investments. But to put all of it in cash creates a greater risk than market volatility, and that is the risk that you're going to outlive your money. And so I educated him. I shared with him our philosophy here at KFG, and I'll remind you of that we believe in diversification to a deeper level than many other financial professionals. Yes, broad diversification using one strategy we call strategic, long-term buy and hold, and most likely that's what you have. Make sure that you're rebalancing right now between stocks and bonds, and make sure that you've got the right risk level between stocks and bonds. But then second, we believe you should add in some additional strategies that diversify among just a buy and hold philosophy. Both of those seek to adapt. Tactical and dynamic both adapt. Tactical will adapt based on what managers are seeing to lean a little bit one way or tilt a little bit another way. And dynamic really is just looking at the momentum of the market and making very quick changes. So that's our belief. I would tell you, make sure you're following a actual disciplined strategy so you're not swayed by your emotions like this individual was. So it is tax season. Most of you have smelled it. Maybe you've woken up in the middle of the night in cold sweats and chills. Around here, it's buzzing at KFG. We do a couple thousand tax returns every single year. And because of the tax plan, lots and lots of questions have been kicked around. Should I continue to do a Roth IRA? I've got lots of kids. Am I going to be hurt with the new tax plan? We've got those questions and more from several listeners. All that coming up here on Wise Money with Korhorn Financial Group. I'm saying that was Ryan
Thunder
upstairs. Did you guys hear that?
Okay, so you thinking we'll be able to get through all three of these questions?
I would hope so. Yeah. I couldn't read your body language if you had anything to add to that investment recap.
I had another suggestion, but it would have taken more time than what we had. So
Yeah.
I was just biting my tongue.
Got it. All right. Well, let's rock and roll. Landing the plane. Should you be doing a Roth IRA, a pre-tax IRA, 401k, all that with the new tax plan? We've got that answer coming up here. This is Wise Money with Korhorn Financial Group. My name's Mike Bernard. Across from me, Josh Gregory here in the KFG studios. Just the two of us today. Kevin is out on vacation. If you've missed anything, go to the YouTube channel at Wise Money Radio. We've got all of the episodes right there for you. You can watch them commercial free, if you will, unless you're calling this a commercial. You can also catch up on previous episodes on the podcast at iTunes and Google Play. Just search Wise Money with Korhorn Financial Group. Lastly, the website, wisemoneyradio.com. The episodes in podcast form are right there, and you can submit a question right there on the right as well. We'd love to hear from you. We've got, a handful of tax questions, and they're just going to keep coming. And so I'm excited to talk through those. I just, would point out, we've spent the majority of today's show talking about what happened in 2017 in the investment world, what to expect in 2018, and some ways maybe you should consider positioning your portfolio for 2018. If you've missed anything, check out those previous episodes, or excuse me, the podcast or on YouTube to catch up on that. Ultimately, make sure that you're following a prudent investment philosophy, not be swayed by emotion. My hunch is there's going to be a lot of emotion driving things this year in the economy with conflicts across the pond, interest rates, and all the political issues that we're dealing with here. So make sure you're following a disciplined philosophy. Micah comes in with the first question. Here's what he asked. What's the best way to get your taxes prepared? Should you do it yourself? Schedule an appointment to have a CPA prepare them right in front of you, or should you drop off your information and pick it up when your CPA is done getting them completed?
Yeah, there's different approaches out there. Even if you're working with a CPA, some do just allow you to drop off your information, give you a shout when they're done, and you swing in, sign here, sign there, and move on for the year, right? That approach, I personally am not a fan of. The do-it-yourself or sit with a CPA and learn, I would even throw another option out there. The approach that we take is we have a CPA or a tax preparer prepare the returns, but then our financial advisors deliver and review the tax returns with their clients. Mm-hmm. And the point here is I would say any approach can work if it drives you to understand your tax picture better. Some people can do their taxes themselves, and by getting in there, get their hands dirty, do the work, it helps them get their mind wrapped around why their tax picture was what it is. And depending upon their skill level, they may be able to even turn their attention then to the year 2018 ahead of them and say, okay, now what's going to be different? The fact that we've had significant tax law changes now may make that harder for the average American. And so if there was ever a year, in my opinion, to consider sitting down with a CPA or a financial advisor who can help you understand why 2017 looked the way that it did, and more importantly, turn your attention to the year ahead, this is the year.
It is. It is the year. This is why we always tell you every show, go, run, don't walk to your certified financial planner's office and set up your appointment. Now is the time, and you need to make sure that your certified financial planner is doing tax planning, and they are either the ones preparing your tax return or working with your tax preparer. There's 3 rules that I have every year you get your taxes done. Josh hit them. I'm just going to put them in order here. First, when you get your taxes prepared, you need to know, why did I get the result that I did? What happened? TurboTax, doing it yourself, you often don't get that answer. You need to know, why did it turn out this way? Second, you need to know, well, is there anything I can do and anything I should do to improve last year? TurboTax is not going to do that. In fact, many CPAs aren't going to help you with that. And then the third is, What's 2018 or what's this next year going to look like and what should I do about it? And I don't know. Mike, in your question, doing it yourself, I don't think you answer, actually, you're probably 0 for 3 there. Sitting down with a CPA to prepare them, you actually might. If your CPA is doing tax planning, you might get all 3 of those answered. You might. Not a lot. In fact, a lot of places that prepare taxes by appointment, you're not sitting down with a planner or a CPA, you're sitting down with a temporary employee who's just been trained on taxes. And then finally dropping them off and then picking them up. There again, if you're not sitting down with someone going through, you're probably 0 for 3. So that would be our recommendation. And just like Josh, I can't think of a better time than right now where you need to be doing tax planning.
Exactly. Tax planning is the key. What we are always trying to burn into your mind is the idea that you should not be cruising around town, meeting with the CPA, and then moving on to your investment advisor's office and talking about their investments, game plan for you. Then maybe try to coordinate things with your insurance agent or your attorney. You could very easily have multiple professionals in your life, each one of them having a separate game plan that they're contributing. Our belief is that your best decisions happen when all of those strategies are integrated together into one plan. That's actually what we call it here, a comprehensive financial plan where your tax picture flavors your investment decisions and your cash flow planning has an impact on your estate plan and so on.
Yep.
That is the approach. That is what your theme for this year should be, to get one plan in place, not just get your taxes prepared.
That's right. Corey has our next question. He's 53. Here's what he asked. I've been saving into my Roth IRA for the past several years, but with the tax changes, I wasn't sure if I should stop that or change that. Any suggestions? I love the Roth IRA. Just to recap, your contributions are not a benefit this year. You do not get a deduction on those, but as you invest that money in your Roth, it grows, hopefully, depending on how the investment's working. You're not paying tax as it grows. And then when you withdraw the money, all of that growth, if it's a qualified distribution, meaning you're 59.5, you withdraw that growth tax-free. And since you never deducted the money you contributed, you don't have to pay tax on that. So essentially, it doesn't help you on your taxes today, but huge tax benefit in the future. Essentially, for most people, the new tax changes should improve your tax situation. And therefore, you'll be paying less tax today. Therefore, you don't need as many deductions for most people.
That's right. That's the point here, is that the Roth IRA makes the most sense in the years where you are paying the least amount of tax.
Well said.
And it has just been determined now, right in front of Christmas, that your tax bill for most people is going to be lower. At least the rates will be lower. So go ahead, take your lumps now, pay your tax now, and avoid them in the future when maybe you'll be in a higher bracket.
I think a lot of you might be thinking, well, I'm losing this exemption deduction. I'm losing this exemption deduction for my kids. In fact, that's Jennifer's question. That's next. I'm losing this deduction, so I need to make up for it. And so I was doing Roth. I need to now do IRA or pre-tax 401k to get that deduction back. Possibly not. There again, do tax planning, because you might actually, even though you're losing that personal exemption, you might be in a lower tax situation and the Roth still makes sense. Let's sneak it in real quick. Jennifer, she's 39. I have 3 kids aged 10 and younger. That's a busy house. And I'm concerned about what my tax picture will look like in the future, since I will no longer be able to deduct my kids on my taxes after the new law. Should I make changes to my withholding?
Well, what she's referring to is the loss of an exemption. I always refer to exemptions as it's the write-off on your tax return that's based on head count. So if you've got 5 people in your house, you get a write-off for 5 people. If you've got 7 or 12 or whatever the number is, you get exemptions. That's the old world.
Yep.
Now those exemptions have been taken away, but what they have given in return is a bigger child tax credit for kids under age 17.
Yeah.
So I don't know how many of your kids, Jennifer, would fall into that boat. But
10, there are 3 kids, 10 and younger.
Okay, got it.
Yeah.
So all of them.
Right.
So you're going to get, where they have taken a tax benefit away, it has been replaced with something just as good or better.
Yeah. Yeah. Now, those of you with kids in college or 17 or older, yeah, there's going to be a little bit of pain there. But there again, do some tax planning to see, well, really what impact is it? Because with fewer deductions, you're now then likely at a lower tax bracket. All the tax brackets, except for the 10%, have been lowered. So you're going to want to take a look and see exactly what the impact is. But my guess, Jennifer, in your situation, probably a wash. In fact, you might even be better off. That is all the time we have for today, folks. I am so glad to have you with us. On behalf of Josh Gregory, myself, and all of us at Korhorn Financial Group, have a great weekend. We'll see you next week for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.